SwayamPrabha. Digital India. Educated India.
Hello, let us discuss about this in session 17 on futures market. In the last session we have discussed about management of transaction exposure using the forward contract, and in this session we will be discussing about management of forward exchange exposure through futures market. In the last session we discussed the drawbacks or disadvantages of forward contract. Forward contracts are illiquid, very high credit risks are there, unstandardized, unorganized market. So, this and also exit from the forward contract is very difficult. So, this difficulty have been addressed in futures market, where futures, foreign currency futures are traded in in a exchange, and the exchange provide liquidity, exchange take care the credit risk side of futures contract, and it is more advantage to have forward future contract for management of transaction exposure. Let us discuss about futures contract. In this session the future contract are outlined, future contracts, the process of future contracts are discussed, and also we will use the future contract and for the transaction exposure management side. We will be discussing 1-2 problems. We will also identify various features of future contract market, and in this process we will be discussing Indian futures market which recently been developed. Let us discuss about the futures market. Foreign exchange futures, a currency futures contract is an agreement to buy or sell future exchange a standard quantity of foreign currency at a futures date at the price agreed between two parties to the contract. There is a contract between buyer and seller for future exchange of currency, and in the contract process the number of contract, that is amount, is fixed, the price is standardized, and the quantity also depends upon the how many contract the particular person is purchasing or selling. However, the contracts are here different than the forward contract, because this contract are traded in exchange. There is a clearing house for this, and all contracts are traded in clearing house, that is a foreign currency and that is exchange traded for contract, and the buyers and seller they do not know each other, and the all trading or settlement, the clearing house or the exchange provide the counterparty, will be the counterparty and absorb all kinds of losses or risks. This system eliminates what is called the credit risks on the counterparty to a large extent, because in the forward contract authorized dealer provide you the contract, and it may happen the authorized dealer may not adhere to the contract, and in the event of authorized dealer not adhering to the contract, the customer has no choice other than going to a court, and the settlement take lot of time consuming process. But here the buyer sellers they do not know each other. The exchange act as the intermediary between the buyer and seller. Exchange provide the counterparty guarantee. In the event of the buyers or seller not adhere to the contract, the exchange will bear the losses, and this there is no credit risk in case of future contract. And what are the features of the future contract? These are exchange traded contract. There is a exchange, there is a clearing house or exchange. The buyers and seller come to the exchange and purchase or buy forward contract, and they do not know each other. However, they act through the intermediary are the exchange itself. Futures are traded an organized futures exchange, there is a exchange future exchange and is organized in nature. Continuous trading provide liquidity to future contract holder, the continuous trading of the future contract. This continuous trading provide liquidity to future contract. It significantly help in discovering the price. What will be the price of next month exchange will come from here, from the exchange traded for future contract you can come to know. To help in discovering the price, and it is a standardized product, standardization in the sense of price, quality or contract size, delivery date. Delivery date cannot be different here. Here delivery date generally in case of future contract for exchange is a 2 days before the end of the month. The contract size are fixed. Contract size in case of India, the future contract size is one contract is $1,000 US dollar. Quality, the quality is also fixed here. The currency are traded, all currency are quality currency. Price also fixed, price also discovered by the market forces, that the buying and selling of the foreign future contract, and they are demand and supply in the market. Mark to market, future contract are mark to market, that is daily MTM, the mark to market to avoid credit risks. The MTN work through what is called a margin money. The buyers and sellers generally have margin account with the foreign exchange. They provide the margin money when they purchase or sell forward contract. The margin money act as a MTM site. So, mark to market, in the event the buyers is getting a benefit, then seller will provide the MTM. In the event of seller is getting the benefit, buyers will provide the MTM. The MTM work through initial margin, both buyer and seller having account in the exchange. Through the account they having money, the liquid money take care the margin money for the mark to market side. The mark to market provides or what I can tell, eliminate the credit risks. In the end of the maturity period, the price will be marked to market and the money will be available with the trade exchange to sell or buy the contract. Novation another benefit of the future contract. Novation is mean the buyers and sellers do not know each other. The counterparty all transaction, the exchange provide become the counterparty for all transaction, it avoid the credit risk. The buyer seller do not know, they come to the exchange, from the exchange they buy and sell. So, exchange become a counterparty in all transaction, it is a novation trading, and it eliminate the credit risks. Clearing house, exchange it act as a clearing house for all settlement. The purchase of contract, sale of contract, the settlement take place in exchange itself. Exchange provide the clearing house agreement. Anonymous trading, what is anonymous means the buyer do not know the seller and also vice versa. Only exchange knows about the buyers and seller for margin and MTM requirement. The exchange knows who are the buyer, who are the seller, because buyer and seller keep the account with the exchange, the initial margin they keep. For the MTN purpose, the mark to market purpose, the buyers and seller are known to the exchange, but who are the buyer, who are the seller, they do not know each other. So, exchange only know who are the buyer and seller, but buyer and seller themselves they do not know. Easy exit, whenever you want to cancel your contract, you can cancel your contract, go to the exchange, you have a purchase contract, sell it, you have a sale contract, purchase it and clear your settlement. Whenever you want, you can exit from the for future contract, because continuous buying and selling is going on, you have to pay only the cancellation charges. There is no requirement, the easy liquidity is available in the market, in the future contract, the easy exit route available. So, it is beneficial for the customer for immediate exit from the future contract, but it is not possible in case of forward contract. You have to go to the authorized dealer and cancel it, you have to pay heavy fine. But in case of future contract, there is not such requirement of heavy fine. When any time you can exit from the future contract, whether it is a purchase contract or a sale contract. Then future trading mechanism, there are mechanisms of trading, because future exchange rate, there is clear guidelines are there, how you can trade, how you can purchase a contract, how you can sell a contract, who will be the trader, what is the short position, what is the long position, who are the floor trader, who are the margin trader, all are available in the future contract agreement side or future contract trading mechanism side. Future contracts are traded in open system of electronic trading system. There is open position, electronic trading systems are available and traders are member of the exchange. All traders are member of the exchange, they buy and sell forward contract for a future contract for their customers, and the electronic trading system is a basic requirement for the future contract. Traders are traders who trade for themselves are floor trader. That is a floor trader, they trade for themselves for their own benefit, for arbitrage opportunity, they trade among themselves, it is a floor trader. Trader who trade for the customers are the called floor broker. You and me go to the future exchange for purchase or sale of forward future contract, then you have to go to the broker. Through the broker you have to purchase or sell for future contract. So, broker trade for us. So, they trade for the customer, they are the floor broker, and the trader who trade for themselves, they are called floor trader. When buyers of future contract take a long position, you buy a future contract, you take a long position, you sell a future contract, you take a short position, and long and short position are the define what is called the interest, that is called open interest. The total long position, total short position will give us the how many tradings are taking place, how many traders, what is the amount of trading taking place in the exchange. The long position, if you purchase a sell contract, you or buy a future contract, if you sell a future contract, you are starting your position, it is short position. While taking a position, both short or long trader pay an initial margin. The brokers or the flow trader, they have an account with the exchange, they provide the initial margin with the exchange, and through the initial margin they take both short position and long position. Since futures are MTM, that is mark to market, as price changes, gain will be credited to initial margin and loss will be debited from the initial margin. The traders are there, brokers are there, they trade in the future exchange. So, future exchange all trade transactions are mark to market, any gains will be credited to the trader's account, any loss will be debited from the trader's account from the initial margin account of the trader. When loss crosses beyond certain level, the trader receives a margin call. When the traders are trading, the losses are MTM losses are there. If it cross beyond the initial margin, the traders get a margin call, and after getting the margin call, the traders have to put money in the initial margin account which is there in the exchange. So, initial margin account generally keep significant amount of margin money for large traders or brokers. The loss generally generally the exchange do not allow losses beyond certain limit, and the margin call will be there for the trader, for the broker to put margin money for future trade. So, and to understand the future market, you have to understand different kind of terminology available in future exchanges. So, that is settlement price. Settlement price is the average last few minute trading price, because all short and long position, all future contract are traded continuously. What will be the settlement price? It depends upon the average price of the last few trades, the settlement price. On settlement price, MTM works, because MTM or that is mark to market works on settlement price. The settlement price, on settlement price, the MTN or the mark to market price decide. Price change, the change in settlement price. What is the price change? Nothing but change in the settlement price. Fall in settlement price, MTN loss per long position. In the fall in settlement price, the long position will be long position, those who are buyers they face MTM loss, those who are seller they gain MTM. So, the fall in settlement price, MTN loss for the long position, rise in settlement price, MTM loss for the short position. Open interest or aggregate of all short and long position, all contract, the short contract, long contracts are there, say buyers and sellers are there on contract side. If you add them, then you will get open interest. Open interest nothing but aggregate of all shorts and long position. Notional principal, there is no transaction of principal in case of future contract. Since notional principal nothing but settlement price into multiplier. The multiplier is decided by the exchange itself. So, settlement price and multiplier decide the notional principal. Total volume, traded quantity. What is total volume of traded? What is, how many quantities are there? Traded quantities are there in the market, future exchange market, that is called total volume. Size of future market, open interest into settlement, in settlement price into the multiplier, that will give you the, that is the size of the future market. Size of the future market, how many trades are there, what is the settlement price, what is the multiplication, multipliers are there. If you multiply all these three, then you will get size of the future market. Liquidity or the traded value, what is the liquidity of that exchange position, nothing but total volume, settlement price and multiplier. So, total volume, how much volumes are the total volume, traded quantity, settlement price and multiplier. If you may add to multiply 3 together, you will get liquidity of the stock future, that exchange future. So, and then each standard, there is a standard size of currency future, each currency market, the future currency market is standard size. The standard size are fixed on the basis of different trading volume. In case of Australian dollar, the standard size is something around 10 lakhs Australian dollar. In case Canadian dollar, in mercantile Chicago mercantile market, it is called 1000 Canadian dollar. Euro 1,25,000 euro. Japanese yen, it is nothing but 125,000. Pound sterling 6250 pound sterling. Swiss franc 1.25 Swiss franc. Indian rupee, the size of the future contract is 1000 US dollar. This is the size of the future contract, it is decided by the exchange. Then how we can use different ticks, how much fluctuation in with there in that is depends upon the tick of future contract. On the basis of tick size, the settlement price or MTN variation, everything calculated. So, what is the tick? Tick is nothing but standardization of future contract related to minimum variation. The minimum variation of contract is called tick. So, standardization of future contract related to minimum variation, the minimum variation is known as tick. Variation in dollar prices for of future contract cannot be random. You cannot, there is no such kind of random variation will be available in a future contract market. So, there should be some size or minimum variation requirements are there, and exchange fix the minimum variation, and the variation on the basis of minimum variation, all other kind of calculation take place in exchange. For example, the minimum variation for pound sterling is US dollar 0.002 per pound sterling. In case of INR, the minimum variation is nothing but Indian rupee 0.0025, that is 0.25 paisa. If a sterling future crosses from 1.8070 to 1.7868, the variation in the value of future contract can be worked out as follows. Suppose you want to use the very tick size variation, how the variation affect the future contract value, then you can calculate through say example. Suppose the pound sterling variation takes place. Suppose in case, as we know, in case of pound sterling, the tick size, in case of pound sterling, the tick size is nothing US del 0.0002. In case of pound sterling, the tick size is 0.002 or pound per, or other word 0.002 US dollar per pound sterling tick size, that is called tick size or minimum variation, minimum tick size or minimum variation of future contract. Now, suppose the pound sterling rate, that is pound sterling rate fluctuate from 1 pound sterling, suppose US dollar 1.8070 and 1.8070 and it migrated to, suppose migrated to US dollar 1.7868. It was 1 pound sterling was 1.8070 US dollar and is after some time is migrated to US dollar 1.7868. Then what will be the future contract value variation in future contract in case of pound sterling? We want to calculate. We know what is the minimum variation of pound sterling against US dollar in future contract, that is 0.002 US dollar pound sterling, and there is a pound sterling migrated from 1.8070 to 1.7868 US dollar. Now, the price variation is here how much? We have to calculate price variation. Price variation nothing but US dollar 1.8070 minus 1.7868. The price variation is how much? Price variation is 0.0202 US dollar. The price variation is US dollar 0.0202. The price migrated from 1.8070 to 7868. The price change or the price variation is US dollar 0.0202. Now, you know that one tick size of pound sterling against dollar is this much. So, how many ticks are there? Number of tick will be number of tick is nothing but US dollar 0.020 divided by 0.0002, that is one tick size. This will be nothing but 101 tick size. If you calculate this, this will be nothing but 101 tick. So, the migration one tick is US dollar against pound sterling. The one tick in future market is 0.002. So, the variation takes place in pound sterling from 1.8070 to 1.7868. The variation is nothing but 0.0202 and one tick size is 0.002. The number of tick will be 101 tick. If you divide this, the variation divided by price variation divided by tick size will give you number of tick. The number of tick is 101 tick. So, but you know that one tick What is the size of the future contract in case of pound sterling? Pound sterling, if you see size of the future contract is 62500, 62500. So, if you multiply the number of tick into contract size, you will give you the price variation. The number of tick into contract size will give you the price value of the one tick, value of one tick, the value of number of tick. Suppose if you want to calculate the value of one tick, the value of one tick is nothing but the value of the one tick is nothing but one tick is contract size into contract size into the tick size, contract size into tick size. So, in case of pound sterling, the contract size is 62500. If you see the contract size of pound sterling is 62500 and tick size is US dollar 0.0002. Tick size in US dollar is 0.002. So, what is the value of one tick? One tick value dollar 12 point, if you multiply this 12.50. So, what is the value of one tick? Value of one tick nothing but contract size into the tick size, that will give you the value of one tick. The value of one tick in case of pound sterling is 12.50 dollar. But how many tick size with the variation of US dollar pound sterling from 1.8070 to 1.7868, we have got how many tick? We have got 101 tick. How we have calculated? The price variation by tick size will give you number of tick, 101 tick, but one tick is 12.50. So, what is the value of 101 tick? 101 tick to multiply 12.50 into 101, that will give you the value is US dollar 1262.50. So, what we have calculated here, if the US dollar, if the pound sterling migrate from 1.8070 to 1.7868, then the future contract of pound sterling, the price variation, the future contract of the pound sterling, the price variation of sterling contract, the pound sterling contract will be 1262.50 dollar, 1262.50 dollar. That is the calculation of using that tick, how the tick linked to the price contract and how the contract value decided, that we have done it here. What we have done it here? You know the tick size, from the tick size you calculated the price variation, from the price variation you calculated the number of tick, price variation by size of that tick you will give number of tick you will give, and from the value of one tick is nothing but contract size into the tick size, that will be value of the one tick. The value of one tick in case of pound sterling is 12.50 dollar, and we have 101 tick variation. So, each variation of 101 tick into the value of one tick will give you the sterling contract variation, sterling contract price variation. Sterling contract price variation is 1262.50 if the pound sterling migrated from 1.8070 to 1.7868. That is using the tick, how you can decide the sterling contract variation or contract variation. Now, in case of Indian currency market, there are number of recently started, just 4-5 years before Indian currency market started, future market, and here future market in Indian Indian currency has some features are there. The features are here, for which are the currency are traded in future market. In case of Indian future market, you have US dollar, you have euro, you have Great Britain pound sterling, and you have Japanese yen. So, there are 4 currencies are available: US dollar, euro, Great Britain pound sterling, and Japanese yen in Indian futures market. The minimum contract size, here contract size minimum is $100,000. The contract size is $1000. What is the trading time? Trading hours is morning 9 a.m. to afternoon, that is 5 p.m. The quotations, all quotations are available Indian rupee. So, all quotations are available in Indian rupee. So, however, outstanding position will be in the form of US dollar. Outstanding position will be in the form of US dollar, but quotations are available in Indian rupee. Tenors, what are the tenors available? Maximum maturity of 12 months, and each month we will get every month there will be a forward future contract, and there is 1 month, 2 month, 3 month, up to 12 month future contracts are available in Indian currency market. Then minimum price fluctuation, that is tick size is 0.25 paisa or INR, that is Indian rupee 0.0025 Indian rupee. Then monthly maturity contract available in the Indian future market, the 1 month to 12 month contracts are available. Since settlement take place in Indian rupee, all settlement take place in Indian rupee. Settlement price is the Reserve Bank reference rate on the date of last trading day. The last trading date, what is the Reserve Bank settlement reference rate, that will be considered as a settlement rate, settlement price, and settlement take place 2 days prior to the last working days of the spot market. 2 days prior to the last working days of the spot market. So, daily settlement take place at T plus 1 and final settlement take place at T plus 2. Final settlement day, last working day of the expiry month. Final settlement is the last working day of the expiry month. Last working day will be the same as the for interbank settlement in Bombay market. What will be the last working day of interbank market in Bombay? That will be the last working day for the settlement, final settlement day will be there. These are features of Indian stock, Indian currency future market. We have USD, US dollar, pound sterling, euro, and Japanese yen future contracts are available, and these contracts are available for 1 month to 12 month, and contract settlement take place T plus 2 days, and Reserve Bank reference rate will be the reference settlement price of the future contract, and contract tick size is 25 paise, 0.25 paisa. And how we can use the currency future market for as a hedging instrument, as a forward transaction or the transaction or management of transaction exposure, how you can use the currency future market. To understand this, let us do a problem. Here problem is here, an Indian tea exporter will be receiving $20,000 in the month of May 30th of the month, 30th May. Since the delivery of US dollar will be after 3 months, that is this we are on March now, and the May 30th the exporter receiving $20,000. It is 3 months from the March, April, May, the 3 months. In between 3 months anything can happen. So, the exporter wanted to immune his position by purchasing a future contract. He wanted to book a future contract for US dollar against Indian rupee. The spot exchange rate as on 1st March is 53.6500, and May futures, that May future in the month of March, May futures are there, month of March May future price is 53.6650. How many contracts the exporter would buy or sell so as to immune the position, and also what is the payoff? If the May futures are traded at 53.550 on and May 30th spot exchange rate is 53.5450 per dollar. the rupee future contract, a contract size of $1,000. So, the exporter receiving $20,000 in a month of May. Now, we are in month of March. In the month of March, spot rate given to us. In the month of March, what will be the May future rate, that also given to us, and also we know that suppose there is indicative rates are available in the market, you have to calculate the payoff now. Since the exporter is exporter, he is receiving dollar, he have to sell contract. So, what he will do? You have to go for sale contract. So, the exporter will sell future contract in currency market. So, now how you can proceed this problem? This problem is you have to understand step by step what is available to us, then you can calculate and estimate the payoff. Here if you see the spot exchange rate at March is exporter receiving $20,000. So, exporter, we have exporter receiving May 30th $20,000. $20,000 he is receiving on May 30th. Now, spot rate, we are in March now, spot rate USD 1 USD spot rate is equal to how much? We have spot rate in the month of March, that is we are in March now 53.6500. We are in March now, and the exporter receiving dollar in May 30th. So, spot rate in US dollar in month of March is 53.65. Similarly, May spot exchange rate on May 30th given to us. The spot exchange rate, suppose the spot exchange rate in May 30th, spot rate USD $1 is May 30th is 53.5450. So, suppose we come to know, somewhere we come to know the spot exchange rate May 30th will be 53.5050. What is the loss? If we do not purchase any forward exchange, future contract, what is the loss for the exporter? The exporter loss will be nothing but the loss will be, so 53.5450 into 20,000 minus, if current rate is 53.6500, 53.6500 into 20,000. If we do not wait, if the exporter does not wait and sell at receiving today and selling at during the month of March, he will be getting 53.65, but he is receiving after 3 months, that is a month of May. So, month of May the exchange rate is 53.5450. So, he is getting less. This loss will be something around how much? Something around, if you calculate this, 2,100 rupees, 2,100 rupees loss. Now, realizing that, he come to know that there will be loss for me if I wait, if I wait for without purchasing a forward future contract, I will be waiting for the receiving dollar and I will be selling during the month of May, I will be getting a less amount. So, he purchased a forward contract, future contract. Now, future contract price will be how much? The future contract he purchased, how many contracts to purchase? You have to calculate fast now. Then he has exposure, exposure is how much? Exposure is US dollar 20,000. The question is now he is receiving US dollar, he have to sell the US dollar in future. So, you have to purchase what is called a sale contract. You have to purchase a sale contract. The sale number of sale contract, number of sale contract, nothing but each contract size in Indian future market 1000. So, size divided by, that is exposure divided by size of contract give you number of contract. So, exposure is USD 20,000 and size of the contract in Indian case is 1000. So, you have to purchase a sale contract of 20, you have to purchase a sale contract of 20 numbers, correct. The purchase sale contract of 20 numbers, but when is purchasing? March, in the month of March only. The future contract in the month of March, May future, May 30th future is USD. If you see the May 30th future in the month of March on spot exchange at 1st to 53 month of May future, which will be delivered on 30th May, is trading at 53.65 So, month of March May future price is 53.6650. 53.6650. Now, he purchased how many contract? 20 contract. He purchased 20 contract by paying per $1 53.6650. Now, in the month of May 30th, price of the future contract is how much? Now, he purchased 20 contract 53.6650. Now, in the month of May, actually May month arrived, and month of May the future sale contract in the 30th of May future sale contract is trading at USD. If you see the example, the month of May, how many positions? The May futures are traded on 30th of May 53.550. $1 will be 53.550. Month of May sale contract. May sale contract is available at on 30th May. When May arrived on 30th of May, on the date of settlement, the future contract sale contract will be 53.550. But he purchased sale contract of US dollar 53.6650, but actually price is available in the market 5550. So, he will be selling because he already purchased a contract, his immune is position, this he will not look at this, he will look at this and he will sell it at 53.6650. In this process, how much gain he is getting? Because the gain is here nothing but he is getting a future gains. The contract side he is getting a future gain. The gain is here. Gain is how much? $20,000 into 53.6650 minus 53.550, because even though the dollar is available, $1 is 53.550 in future market, but since he has purchased the future in during the month of March at this rate 53.6650, his position is immune, and that exchange will provide him 53.6650, not at 53.550. So, the gain will be how much? Gain will be nothing but the gain will be 2200 US dollar, a 2200 Indian rupee. But by purchasing future contract, he is getting a gain of 2200 US dollar, but by not adhering to the what is called suppose he does not purchase any future contract, he is open his position, he will be facing a loss of 2100. So, the actual gain for him is $100, for him is 100, that here the actual payoff for him is 100 rupees. Not hedging anything, he will be losing 2100 by by adhering to the future contract he will be getting 2200. So, there is a gain for going for a future contract. So, this problem what you discuss in calculation process I have analyzed here, you can see it. Spot exchange rate on March 1st 53.65, spot exchange rate on May 30th, because he receiving dollar in May 30th is 53.5400. Receivable amount is $20,000. So, if he does not hedge his position, then he will be getting how much? He will be selling his dollar at 53.5450. Why? His dollar will be arrive in month of May only. So, he will be selling at dollar 53.505, 53.5450. So, but dollar is depreciating, rupee is appreciating, he is getting less. So, there will be loss in transaction process 2100 rupees. Now, realizing this loss, he has gone for a future contract purchase, because he realized that rupee may appreciate. So, he will be getting less amount of rupee. So, he will go for a future contract. So, how many contract? The size of the future contract in Indian future market is $1000, but his exposure is $20,000. So, number of future contract need to sell, because he is receiving dollar, you to sell the dollar in the market. So, exposure amount into contract size will give you number of contract. Exposure amount is 20,000, contract size is 1,000, 20 contract need to sell in the market. Purchase contract, sale contract, you have to purchase sale contract. But when you will be purchasing? Before dollar arrive during the month of March only. In the month of March, May future price is 53.6650. So, 53.6650 he will purchase 20 contract, and when actually May arrive on 30th May, the future contract price is trading at 53.550, but already he signed a contract with the exchange. So, he will be selling his dollar not at 53.550, he will be selling his dollar 53.6650. So, he is getting what is called gain in future contract some amount, at how much amount? 20,000 into 53.6650 minus 53.550, that is 2200. 2200 Indian rupee he will be getting. If he sign a contract, he will not lose 2100, he is getting a extra of 2200. So, the actual gain will be 100 only, will be 100 for him. So, this is the process of calculation of payoff for the future contract, and here we have learned two things. How many contract in case of exporter receiving foreign currency, you have to purchase sale contract. Importer need to pay foreign currency, you have to purchase contract. Two things. Second thing, size, number of contract is nothing but number of contract is exposure amount into divided by size of the contract. So, exposure amount is 20,000 here, size of the contract in Indian currency market, future currency market is $1,000, this 20 contract. So, the number of contract is nothing but exposure amount divided by size of the contract, that will be the number of contract. Number of contract, that contract he to purchase or sell at the prevailing price, market price of the contract. Now, that is the amount he is supposed to pay at the signing of the contract, and this contract will be continuously traded when the maturity date of the contract arrives. If the maturity date the price is more or less, the gain or loss depend upon the what kind of contract you have purchased, the sale contract or purchase contract, and on that basis you calculate the payoff of the matrix. The payoff or transaction profit or loss on the basis of settlement price, you have to calculate that. Future contract are very helpful, because there is no liquidity problem, there is no exit problem, there is no credit risk in future contract. However, there are number of disadvantages are there in future contract. Future contract size is standardized. So, you cannot customize the product. Future contract size standardized in not only in price, not only in the volume, not only in the size of the contract, but also what is called delivery date. If the exposure in between before the delivery date, then the future contract will not help us. You have to go for a forward contract further. So, future contract some extent help in large scale large amount of exposures are there, but small amount of exposures are there. It is better for the customer to go for a forward contract, and both forward contract and future contract together only can immune the position of the hedgers, immune the position of the hedgers or exposure, those who are exporter importer. That both currency future market and forward contract market together only possibilities are there for hedging the position. For reference side, you can use the RBI annual report and also economic survey of Government of India. Here future market, Indian future market development is mentioned there. RBI annual report also provides the future market condition in India. You can go to the NSE site, NSE National Stock Exchange and Bombay Stock Exchange site and see the Indian future market, the trends and progress of Indian future market. There also will come to know the calculation process of future market in India. NSE site or future currency future market is highly traded future market. You can see the trading volume, trading size, settlement pattern, settlement rate and other features of Indian currency future market. Here the model question for you, they explain the various features of futures market and bring out its distinct advantages over the forward market. The various features of in futures market we have discussed already, and also what the advantages are there over forward market, you can discuss there. The advantages here, credit risk is not there in case of future market, liquidities are available, settlement patterns are there, prices are standardized, market is standardized, and also the continuously trading allow us to exit from the future market anytime, which is not available in case of forward market. The Indian importer, you can go through the example. Here one problem I have given to you, same problem which we discussed in export side, I brought it here in the importer side. An Indian importer will be paying $40,000 US in May 30th. Since payment is in US dollar will be after 3 months, the importer is facing transaction exposure in US dollar against the Indian rupee. He wanted to book futures contract for US dollar against Indian rupee. The spot exchange rate as on 1st March is 53.6680, and in May future running during May future running during March 53.6685. How many future contract the exporter would buy and sell so as to immune its position, and also what is the payoff if the May futures are traded at 53.6825 and May 30th the spot exchange rate 53.68 per US dollar. The rupee futures have a contract size of $1000. We have already discussed the problem for the perspective of exporter. You can discuss this problem and do the problem for the perspective of importer. The solution is here. The spot exchange rate on March 30th is 56.60, for May 30th spot is 53.68. So, payment amount is $40,000 US. So, if we not hedge, then there will be loss of 480 rupees. If you want the loss, to avoid this loss, the importer purchase contract. So, purchase contract size 1000, exposure is 40,000. So, 40 contract he purchased from the market, and in the month of March he pay for contract 53.6685 per dollar. So, and but May 30th actually arrived, the future May future running at 53.6825. So, but he will again on future contract is 560, and here payoff will be 8560 and 480, that there will be payoff of 560. The May future is running 53.6825 per dollar, but already the importer signed a contract 53.6685, he will purchase the dollar at 53.6685 in place of 53.6825, there will be gain for him. The gain is 560 per contract, 560 rupees per contract. So, there will be per contract there will be the profit of 80 rupees, and he has purchased 40 contract. So, that you can calculate the amount, the rupee gain here. Thank you.